Hello, this is Dove Byrne with Humboldt State University. This video is for BA 360 Principles of Finance and is a help video for the final examination. I asked students to post topics they'd like me to discuss during the help video, and I got a few sent in. The first question was, what type of conditions should be considered for the types of investments, and in which chapter should we focus on to determine the recommendations for each investment? Is it just going to be a simple invest in or not type of a recommendation? The conditions you should consider are risk versus return. What type of risk is being taken in a certain investment, and is it providing enough return commensurate to that risk? So that's what we're really going to be looking at. You're going to create a series of spreadsheets that analyze an investment, and then you're going to take into account risk when deciding whether or not a certain investment should be pursued. Now, risk is really in the eye of the beholder to a certain extent, in that some people are risk averse. They do not want to take on a lot of risk, and therefore are willing to trade off risk for return. Lower risk equals lower return. Other investors are willing to take on a lot of risk because they want a very high return. So that's what we're considering, is risk versus return. So in this final, you're going to create the spreadsheets to do the analysis, and then you're going to do a write-up. And that write-up has to match your results. And when choosing an investment, you're going to have to take risk into account. You can say, well, if the client does not want to take on a lot of risk, then I would recommend investment number one. However, if the client is willing to take on risk, then investment two would be considered. So I don't want to say there's a right and a wrong answer. Well, there certainly is. But as long as your analysis is correct, and as long as you say, for example, I'm recommending that the client keep their money in a savings account because it is the least risky of the options. So that analysis matches the client's ability or willingness to take on risk. So as long as your analysis matches the principles and the concepts that we've learned throughout the book in terms of risk, and we'll consider other things like the efficient frontier. We certainly wouldn't want to recommend an investment in a portfolio that did not fall on the efficient frontier. So will you be making a simple invest in or not recommendation? Yes and no. You're certainly going to analyze each individual investment to see if it is a interesting investment, if it's an investment that could be considered. Now, if you find after your analysis that all four investments could be considered, you're going to need to pick one. And you can make some assumptions. You can say, I'm going to assume that the client does not want to take on any risk, and therefore I'm going to recommend this recommendation. Now, if you recommend that the client leave all their money in the savings account, that's okay. But your analysis for all of the other options is going to have to be correct. And I'd also want you to suggest the conditions under which you might consider another investment. What conditions might you recommend the investment to buy a business? Or what conditions should exist for you to recommend investing in the options market? So there's lots of right answers. It's just that your analysis has to be right on. And I don't want you to ignore the other options. I certainly want you to discuss conditions in which each of the four investment options would be agreeable if you find that they are all quote-unquote interesting investments. An interesting investment being an investment that a reasonable investor would consider. An uninteresting investment would be an investment that falls on the efficient frontier, or that does not fall on the efficient frontier. The next two requests were for a video talking about investing in the stock and or bond market. Those are both for. So I'm going to spend most of this time, looking at portfolios, the capital market line, the security market line, and minimum variance portfolio. So here's your final study guide. The first option was keeping the money in a savings bank. It's going to be pretty simple analysis there. And again, you're going to want to present this savings bank analysis as if the client has no tolerance for risk. I might recommend keeping the money in the savings bank. That would be very short, quick analysis, but that does not mean you can ignore the other options. If you find that buying a business is an interesting investment, then you'd have to say, well, if the client is willing to take on some significant risk, then they could get a return of X by buying a business. And the same for investing in the stock market. We have lots of different options. In the final, you're going to be given 3 different combinations that you can create a portfolio out of, or that you can just invest in those 3 options. You basically can invest in 1, 2, or 3 of the different stock and or bond options. You'll be given the S&P 500. That will be your market rate. So if you want to find the expected return on the market, you'll need to go back, get 5 years of monthly returns, average them, annualize those returns, and then take the average return on the S&P 500 over the last 5 years. That would be your expected return on the market. We could use that for both the capital market line and the security market line. You'll also be given a 5-year treasury bond as your risk-free investment option. This will be your risk-free rate. You don't have to look up the treasury bond on Yahoo. I give you the yield to maturity over the next 5 years, and you can use that as your risk-free rate for the security market line, for the capital market line calculations. And then I'll give you a company, a publicly held company that you can also invest in. So what can you do with these 3 different investment opportunities? Well, you can create a portfolio of the S&P 500 and the publicly held company that I gave you. That's much like what we did in our project this semester when we did the portfolio project. And you can certainly calculate the minimum variance portfolio, because what that will do will tell you all of the interesting investment opportunities. Those are these efficient frontier points. So based on this company, it looks like investing in the S&P 500 all the way from 0% all the way to 66.68%, and therefore investing in the combination of, if it was 0% in the S&P 500, of course it would be 100% in the company. If it was 66.68% in the S&P 500, you'd be investing 33.32% in the publicly held company. So all of these investments are interesting, and you can pick one. You can say, well, if the client can certainly choose a portfolio that is some percent S&P 500 and some percent the publicly held company, but the percent that you invest in 500 has to be between 0 and 67%. Any investment beyond 67% in the S&P 500 will not give you a better return for the risk that you're taking on. Those investments just do not exist on the efficient frontier. So these are the interesting investments. So we would need to pick one of these investments if we were going to recommend a portfolio of the S&P 500 and the company. You could also say, well, I'm going to recommend that you invest in just the company, and you can expect a 2.67% return. Or you can invest just in the S&P 500. I'm sorry, that was the variance. You can expect 11.71% return if you just invest in the company. If you just invest in the S&P 500, you could expect a 6% return. If you invest in some combination, your returns will range from 7.9% all the way up to 11.71%. You could also invest in an optimum portfolio. Remember, an optimum portfolio is the capital market line. That's where you invest in the S&P 500, some percent in the S&P 500, and some percent in a risk-free security. So that would be another investment. You could look at that return. You could look at just investing in the risk-free bonds and see what kind of return you could expect on that. You can invest in one, just the risk-free bonds, just the S&P 500, just the company, or you can group the S&P 500 with the risk-free rate or with the risk-free bonds, or you can group the S&P 500 with the company. If you're feeling so inclined, you can certainly also invest in the S&P 500, the company, and the risk-free bonds. And you can look in your, I believe that's in chapter 11. Here's a thumb through the book. You could certainly look at the Sharpe ratio if you want to get into some advanced portfolio statistics on page 359. But I certainly wouldn't expect it or require it. So you can use the portfolio analysis that we learned, you can use the security market line, you can use the capital market line, and you're going to be just calculating returns and calculating risk. And then you're going to present all the options, and you're going to choose an option, and you're going to choose the conditions under which you would select that option. For example, if you say, I'm going to assume that the client risk does not bother the client, so we're going to go for the highest return and therefore take on the highest risk. And in this case, for the portfolio, you'd say we're investing only in the company, and we're expecting a return of 11.71% with a standard deviation of 16.34%. Remember, the higher the standard deviation, the higher the risk, the higher the average, the higher the return that you can expect. Here's your portfolio. Looking at the capital market line and the security market line, again, your risk-free rate, that's the rate of your 5-year treasury bond that'll be given to you. The expected return on the market would be the average annual return of the S&P 500 over the last 5 years. This would be the average of the S&P 500 so you'll look at 5 years of returns, you'll calculate 5 annual returns from 2008, 2009, 2010, 2011, 2012, and then you can take the average of those 5 years of returns to get your expected return on the market. So that's how you get these two numbers. This percent invested in the market, again, it can be from 0% to 100%, just depending on how much risk tolerance the individual has. And you could create a range, do a little data table and create a range to show the different, how the expected return on the company changes based on how much you invest in the market. Actually, this shouldn't say company expected return. This should say optimum investment expected return. Because that's what the capital market line, it measures an optimal investment. Some percentage of your investment goes into the S&P 500, the market. Some of your investment goes into a 5-year treasury bond, or in this case, the risk-free rate. The security market line can measure the expected return that you would get for just investing in the company. Again, we take the risk-free rate as the 5-year treasury bond rate. We take the expected return on the market as the average of the last 5 years of returns that the S&P 500 produced. You'll get your company's beta. You can calculate this based on a regression, which I haven't done, but you can do your regression and you can have the equation shown, and you can look at that beta from that equation, or you can calculate the slope of your data points of your regression line to get your beta, or you can look up your beta on Yahoo. If you look up your beta on Yahoo, you go to company statistics, you grab that beta, you plug it in here, and this tells you the expected return that you would get if you just invested in the company. So the capital market line is for an optimum investment, a combination of the risk-free bonds and a market, the S&P 500. security market line just measures the expected return for the company using the company's beta, the risk-free rate, and the expected return on the market. Again, you'll be given the risk-free rate. You'll have to calculate the expected return on the market. And then you can present all of these different investment opportunities. The investment opportunities would be the range of portfolio investments that exist along the efficient frontier. So we might say here, this would be from 7.9 up to 11.71%. So 7.9%, 7.9% all the way up to 11.71%. We could just look at just investing in the capital market line, and then we could look at those ranges. Those ranges looks like they go from 3%, of course, all the way up to 100%, all the way up to 8%, because those are my two different rates. So here we would say 3% up to 8%, and we could also make a little note here, min, max, and then we could look at the efficient minimum variance portfolio here as well. The security market line, that would give us, that's just going to give us one rate, 12.05%. We could look at just the 5-year Treasury bond, 5-year Treasury. 5-year Treasury bond, in this case, that would be a risk-free rate of 3%. There's the 3% for 5-year Treasury. You could just invest in the S&P 500. If you invested just in the S&P 500, you would expect an average return. In this case, these aren't the real numbers, so be careful, but the average return of 6%. If you just invested in the S&P 500. And then you could invest in the company. The company's return here, the company average is 11.71%. Go. And then you could look at the efficient frontier. We looked at the efficient frontier already. That's the combination of the portfolio. The capital market line is the optimum investment, and that range will be dependent on how much you invest in the S&P 500. Security market line is just the expected return just of the company, and these two numbers basically are giving you the same number, are calculating the same thing, just calculating it two different ways. So those are the ranges of, those are the investments, and then you could talk about which one you could go after, dependent on how much risk, what risk tolerance the investors have. So again, just create your Excel spreadsheets correctly. Use good information and good numbers. Don't try to do too much. Give me the expected returns. Talk about the risk. If we want to include this minimum variance information here about the minimum variance portfolio, we could just set our percent invested in the market to our minimum variance portfolio, and then we could, actually this should just be its own little investment, minimum variance portfolio. Be a portfolio that creates the least amount of risk, and that portfolio would be 6.33%. So we have our expected returns, our average returns, and then we can start talking about the different risk associated with these different investments, and I'll leave that up to you and the reading to do that. So really just try to be efficient. Don't give me more information than I need. Your write-ups can be to the point. And your analysis should cover the different levels of risk tolerance. For example, if the client is not risk averse, then you might suggest a certain range of investments. If the client is willing to take on risk, then you might suggest a different range of investments. So if you make an assumption like, I'm going to assume the client is very risk averse, then state that in your analysis. I hope this video was helpful. Just rely on everything you've learned. You've got the book. This is an open book final. Take your time. Don't give me junk. And what I mean by that is don't just give me information. Don't just try to pack as much information as you can here. Just give me the information that you need to perform your analysis. And in your write-up, try not to ramble on. Don't put in a lot of filler. Just get to the point. State your assumptions. State the conditions under which certain investments would be good or would not be good. And then just come up with a recommendation. You can talk about the different types of recommendations and different types of assumptions in your write-up. But in the end, just come up with some way to invest that money and then put some thought into it and tell me why. And as long as you make correct assumptions, as long as you create your spreadsheet correctly, you'll do fine on this final. I really enjoyed teaching this class this semester. I hope you enjoyed it too. I hope you can use all these tools and everything you've learned in your life, in your career, and at school. If you'd like to come and meet me in person, I'll be on campus in the fall. Just come to my office, and I'd be more than happy to talk to you about anything. Have a great final, and enjoy the rest of your summer.